The S&P 500 rallied over 10% from August 5th to August 30th, closing near all-time highs just this past Friday. However, now we're entering the month of September, which is historically the worst performing month looking back over the past 100 years. So will this September be a sell-off month like the historical average? Or is the data pointing to further gains to come? The first data point that I want to look at is the McClellan Summation Index. This is actually a market breadth indicator. One of the big differences that we see right off of the bat is the all-time highs that we saw in July actually had a divergent trend happening. The number of advances to decliners were significantly on the declining side during that July rally. And so this was a huge indication, especially during this last part of the rally, that we may be peaking at least temporarily. We're in a bit of a different situation now on this most recent rally. We can see that we actually have some pretty decent participation here, with the number of advancing stocks significantly higher than the number of declining stocks. We start to get a little bit of a clearer picture looking at the S&P 500 heat map. Stocks like Nvidia over the last week having a down week, Broadcom, AMD, Meta, Google, all of these names on the weaker side. However, when we actually take a look at the breadth of the market, we see a number of names participating: the financials, health technology, manufacturing, retail, trade, energy, health services, commercial services. So we have broad market participation in this most recent rally. And that's a big difference for what we were seeing in July at the all-time highs. We didn't have that breadth, that market breadth that we need to have a sustainable market rally. During this period, the leaders were mostly the Mag 7 names. Obviously, that's not sustainable on a long term. However, on this most recent rally, we see breadth picking up, as I mentioned, and we see a number of market sectors leading, which increases the odds for a continuation. The next data point I want to look at is the gamma exposure data for the S&P 500. In the purple bars here, we have the net gamma exposure data. Now, if you're not familiar with gamma exposure, I'll put a link to our GEX playlist in the description below. Of course, looking back over the last week, the S&P 500 has been in this consolidation zone, really coiling for a potential move higher. This is the kind of healthy market action we like to see. Early August saw that really nice rally, and now we're just consolidating. For the past week, just a really nice healthy consolidation. But look what we have here. We've got 5,700, 5,750, even the 5,800 strikes. These are large gamma exposure concentrations in the options market, pointing to market participants positioning for higher prices. And so as we potentially break out of this consolidation zone, we can easily see a stronger move into positive gamma exposure levels and potentially into the 5,800 strike in the month of September and October. Another factor I just want to point out is a lot of times when we see market breadth picking up, for example, here at the end of 2023, we had market breadth really increasing over the preceding 2 months. It did top out, and we did see a pullback after that breadth peak. The same thing happened at the end of March. Really nice rally into the end of March for the previous 2 months. We saw market breadth peak and start declining. This was a little bit larger of a pullback before the rally continued. As I mentioned at the beginning of the video, we had this big divergence in market breadth, where breadth was actually declining as the market continued to the all-time high. A big red flag and signal that participation was not there. The flows just weren't there in the market to justify those higher prices. That led to a really nasty sell-off into the August 5th capitulation, which was the volatility scare that we had right there August 1st through August 5th. And since that point, though, breadth has really been increasing along with market prices. Let's come back here to our gamma exposure dashboard and look at a few potential scenarios of how this could play out over the next few weeks. As we mentioned, the S&P 500 has been consolidating, and we are on the precipice of potentially breaking out of this zone. So a potential path for the market could be a further continuation up into this 5,700 strike. That would put us right into this dealer cluster zone. This is where option dealers in the market are clustered, as you can see these large gamma exposure clusters. And so as price moves into these levels, option dealers will potentially be forced to sell the underlying securities in which they are holding. In the case of the S&P 500, that would be selling futures. And this is classic gamma exposure behavior that forces price back down, eases the pressure off of the dealers, allows them to reposition, and new buyers ultimately will come in, take advantage of those lower prices. And we see this playing out with positive gamma exposure environments where buyers step in on dips and they sell the rips. This often leads to trending market paths that we often will see in these kind of channels that form in the S&P 500 or in the Qs or any of the major indexes that we see. So this is scenario number 1. And this is our base case scenario for the next couple of weeks in the market. Scenario number 2 is this consolidation has an initial failure down to the 5,500 strike, dipping just slightly below the 0 gamma level into negative gamma exposure territory, causing market participants to start freaking out again, thinking that the lows are coming back before buyers step back in, lifting prices back into these large positive gamma exposure concentrations higher. Let's just take a bird's eye view of the gamma exposure data graph. The largest positive gamma exposure concentrations are at 5,700, 5,750, and we even see the 6,000 level growing. These are levels we've been watching for the last 2 to 3 weeks as the market reversal really took hold. As long as we stay in or around the 0 gamma exposure level or positive gamma exposure, we think that price will continue to gravitate towards these levels as the market trends higher. The 5,700 to 5,750 levels are our first target zone. And so we are beginning to position ourselves for a further move into this range. Going out further in time into the month of October, we see 5,800, seeing a lot of market participants starting to position at that level. And then going into year end, the 6,000 level, this is a lower probability move because the further out in time you go and the further up the options chain you go, of course, the probabilities are reduced because there's so many more variables that could potentially factor in. However, it's interesting to note that there are a number of market participants that now believe that the 6,000 level is a potential target for year end. So we'll continue discussing the market data and the trades that we're watching this week in our community Discord. Come on in and say hi. I'll put a link in the description below. Also, if you're interested in accessing the tools and analytics on our dashboard, head over to geeksoffinance.com. You can sign up, become a member. You'll get access to our GEX dashboard as well as our Geek University course, which is a 5-hour option strategy, gamma exposure, volatility trading course. This is included for free for all of our members, so definitely check that out when you get a chance. Thanks so much everybody for watching, and we'll see you guys in the next video.